The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman on this 4th day of May. My pleasure to be here Monday through Friday on market days at 11 o'clock till noon Eastern Time. And as you heard, 877-927-6648. That's the number to call. Thank you to all our hosts prior to this show. It's just a great learning experience, great opportunity to get information and advice. Let me just quickly say, I've got a webinar coming up tomorrow night. This is the second of my series, and it is about the stock market parallels between now, the era we're in, and I mean the era that we're in, and the era of the late 1920s going to the 1929 top. Is there a match? What is matching? What is not matching? What is the missing ingredient at this particular point? There is a major missing ingredient as far as I can see. And we'll be talking about that. We'll also be talking about chart formations. I'll be going through the litany of the theoreticals, the practicals, the demonstrable statistics. And then we'll be looking at the charts and seeing what is matching right now. Is there a match? If that match is unfolding, where are we? And what does it mean to your portfolio? And what should you be doing? What should you be thinking of? And what levels should you be looking at in the marketplace for support levels to where you want to say, hey, maybe it's time to lighten up or maybe time to add. We'll talk about that. Tuesday night, let me see if I can get it right here on the front page of TFNN. There it is, TFNN. So there are a couple of webinars going on. First of all, mine, this is the second one. The last one from last Tuesday, April 28th, I think it was, is still relevant. It's still there. It's archived. You'll have it on your page, and you'll have a 30-day free subscription trial to my newsletter. Very educational newsletter. I always send out charts. Even over the weekend, I sent out charts. That's so you would get the Tuesdays and you'd get tomorrow's and 5:30 to 6:15. Might go a little later, but that's tomorrow night, Tuesday night, May the 5th. And it is a very comprehensive look, a little brief summation of the Chapman wave forms and Chapman wave techniques. Mostly we'll be going into the parallels and non-parallels of where we are right now with 1929. Doesn't mean, I keep emphasizing, doesn't mean that we're going to go into a major market crash and a depression again. No, there are many, many safeguards. Now, it's interesting. The Fed started in the 1913 period. So they had about 15, 16 years to kind of come to grips with the macro visions. But, in fact, that whole 29 scenario was totally foreign to them. So we'll be talking about those charts, talking about the different issues involved. Don't forget, this is now, so the archive is essentials of the Chapman wave, and the live May 5th is the 1929 market revisited, where we are, what we're doing, what we can expect, what areas should benefit if there's another big move to the upside, what areas should have a problem if we start to decline. Now, we're also looking at Steve Rhodes has the Psychology of Trading, a new two-part webinar starting on, I believe it's Thursday, May the 7th. Yeah, May the 7th and May the 14th, 1 week apart. Check it out. Human pattern recognition. You know, Steve takes a lot of time and effort into creating associations with things that we do, with the preparation involved, and how you can best qualify your emotions and trade within the spectrum, within the parameters that you choose. And it's very important. So I think that take the opportunity. Education, believe me, whatever you pay, it is a learning experience. One trade, one little mistake could cost you what you get. In fact, if you're looking at these, if you're looking at mine, you're not paying anything because you have not only that, you're getting a bonus. You're going to have a month free of my opening call. My service, my daily service, very comprehensive look at the markets every single day. And and in Steve's case, it's really well worth it. So here we go. Get out of that. This is the E-mini up 925 at 2,110. Let me show you something. Do I still have it? No, I don't. Of course, I took it away. All right, during the break, I'll change over. But there is a lot of resistance, and I showed the chart this morning. I said there's a lot of resistance in the 2011 area to 2014 with 2111 and 2114 with 2119.75, the all-time high in the E-minis. And this is the area that the price should be repelled quite a bit. So we're looking at it, and yes, it's been repelled from the high of the day, which is 2115, was it? 2115 exact, and we're trading now at 2111. Still very good action. The stochastics at 93%. MACD in the 120-minute chart is good, getting a little bit toppy, so we'll watch this real closely. There, just a series of cup formations and arch formations. That's what we've been looking at, and what has been the real issue has been that we've been trading in a rectangle formation, and a rectangle formation can be very frustrating to both bulls and bears, because if you think it's going to break out, it doesn't. What it does is it reverses. If you think it's going to break down, it doesn't. It reverses at those upper points and lower points, and that's what's called a trading band. And we've been in the band. The band has been marching away with a Sousa refrain, and it can be frustrating, but it can also be rewarding. So let's go to the numbers. We're looking at, let me move this over just a tad, right there. Good. So we're looking at the Dow. Up 77 at 18,101. 18,288 was the last high. I'll do it with the charts as we move along. Here we go. So single leg, this is a leg C in the 120-minute chart. Could fail, but we'll see what happens here. The daily, nice move up, repelled by that arch formation that I drew in for subscribers to show them that there's a repellent area, and the same thing is occurring in the weekly chart. So a snap through to 18,190s would start to be a bit of a breakout, but 18,288 is really the level that it needs to take out. And this week, if it's going to do anything. In the meantime, back at the ranch, the support that has to hold is between 18,000 and 17,930s. If there's any turn down, that'll be the key to seeing what happens. And then the volatility index, which once again is down, it's at 12.83, is holding the 12s very nicely. A break into the 11.80s would suggest that we could go to the 18,288 level in the Dow, and a break above 1450-ish this week would suggest that the selling pressure is coming in as we go to the downside in this rectangle trading band. Let's go to the S&P, SPX.X. That's the S&P 500 index. Hasn't broken out above the 2120 resistance. No. Wait a minute. Whoa. 2125.92. 2125.92. At this particular stage at 2117, you're looking at a little bit of a distance to go, 9 points to break out. So it could do it. We'll see what happens. Basically, we're looking at 2106 as the 9-period exponential moving average support. It's already made a leg D. It's not a peak D yet. If it doesn't all week break above 2120.49, it will be a peak D. I'm going to be spending quite some time talking about this tomorrow night, about the S&P, the time, not the price, but the time match that's going on right now. And the S&P just had a peak F top. It came tumbling down to the lower part of the range, and that range is down at the low that was made at 2075, was it? 2077.59 on the S&P, and this is so far leg B. Yep, the leg B to the upside. It could fail as long as it's underneath that high that was made at 2125.92. So now let's go to the QQQ series. The QQQ series, same thing, a big spike up over the last two sessions in the 120-minute chart. But this is the area that's going to be tough to break out of. The QQQ series, this is the PowerShares QQQ Trust, is at 109.50, up 45. Really struggling, actually. And look, struggling within the higher price range. It's in the upper level. So this is a high-level consolidation. But most importantly, when I say struggling, is that the decline last Friday. Yeah, last Thursday to 107.06 was a little deeper than it should have been, but it held the 9-period moving average beautifully. We have now a Roman candle, Chapman wave Roman candle for last week in the weekly chart of the QQQ series. Very important. If at any point this week the QQQs break 108.36 and hold there for 3 to 4 hours, there's a real good chance we will test that 9-period moving average in the weekly of 107.88 yet again. On the upside, if there is a break to the upside by Tuesday afternoon or Wednesday morning above 110.15, I would suggest there's a good chance we're going to try for a double top. So this is a very important period. Now let's do this. We want to look at the New York Stock Exchange. This is the beginning of the week. We want to get a good comprehensive look at everything. See, from the last peak that was made in almost all the indices, there was a very sharp pullback, but then the left side low bar mostly held, or the 9-period moving average in the weekly chart mostly held. And then the rebound on Friday was a little bit, no, I wouldn't say a little bit, it was quite a bit stronger than I was anticipating. Because of that, I cannot rule out that there won't be at least an attempt to try to make new highs this week. That's why I think it's very important at this particular point to stay. I had a question from a subscriber. Wait a minute. What exactly is going on? There's a little difference between the overview section and the trades. And I said, look, I'm emphasizing here that the trading range has been set in place. I recognize it a little late. Otherwise, I would have just kept trading from the low bars in the S&P. I would have gone to the long side. And as we were trying to test the top, I would have gone to the short. But, sometimes a rectangle formation takes a while before you can. My only confusion was that the S&P, which one went to new high? One of the indices went to new high, and I thought to myself that might change the rectangle formation. That's all. So no, we're in that rectangle formation. Now, the New York Stock Exchange has done the same thing. What's really impressive about the NYSE is that the monthly chart has gone to a leg C. It could be a peak C if there's no new high bar this week. And the technicals are sort of failing, but you've got some nice support in the weekly chart, and that's important. So I'll talk about more of these. I'll talk about gold being up $13 and bonds being down 0.5 point and the dollar as soon as we get back. Basil Chapman, Tiger Conditions Hour. Dow's up 69, S&P's up 8.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe Future Economies CD. This is a CD that could really deliver, but you have only until May 7th to take advantage. Consider the facts. If the Future Economies currencies beat the US dollar over the CD term, you'll get all of the upside. And should they lose? No worries. There's zero downside risk here, as you'll still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Basil Chapman has just announced 2 live workshops that he'll be hosting April 28th and May 5th that only subscribers to his opening call will gain access to. On April 28th, Basil will host a 45-minute live online workshop, The Essentials of the Chapman Wave, where he'll teach the basics of the Chapman Wave notation that Basil created and uses daily in his trading and newsletter recommendations. On May 5th, Basil will host a second 45-minute workshop where this time he'll revisit the 1929 market comparison webinar and provide his attendees with an updated take on the socio-economic trends Basil has spotted currently taking place. If you're an opening call subscriber already, then your seat is already reserved. If not, then sign up for a 30-day free trial to the opening call today. You get a month of Basil's daily newsletter, The Opening Call, along with 2 live workshops coming up. Don't miss out on this offer. Sign up for Basil Chapman's opening call newsletter today on the front page of TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Folks, so we're back. So we're looking at gold. Gold's within a trading band, also within this kind of rectangle formation, trying to bounce right here, up $13, $14, $11.88. Repel from the 9-period exponential moving average as the continuous contract. We'll watch this real closely because let me show you the dollar in the daily. Look at the daily dollar. The dollar is bouncing. I wouldn't call it a rally. It's only a bounce, but the dollar appears to be forming some kind of lower highs, lower lows, while gold is held very, very well. And it seems, instead of being on the higher highs and higher lows, it's just holding nicely. And let me put this down a little bit, this rectangle. There you are. If I draw it like that, you'll be able to get a better picture. Also within the rectangle formation, but I can just tell you this, that if gold, the continuous contract, closes under 1168 is the low, but if it closes under 1163, there's a real good chance that it's going to test or get close to the 1142.50 low that was made back on the 17th of March. My looking at the charts right now with the MACD a little bit flat, negative but flat, suggests that there actually is some support here, and that the rectangle that I've drawn is going to be very important. Now, let's do this. I want you to look at questions I had. Yeah, I want to thank all of you for sending me all those notifications about the different mega buildings, etc. Yeah, Google and Amazon and Apple. It's just there are amazing things going on out there on the West Coast. What does it signify? It signifies an era, the mega era. And I'll be talking about that tonight. I won't talk too much about it because this is just a general thing that I often mention on the show. But I will be talking about it. And so let me just finish up here. I want you to look at high-grade copper. Look, high-grade copper pulled back last night. It's holding very well. And I got to put this into the whole potpourri of the sequence of things that we're looking at. Look at the inside track that it held right there, that channel, that huge up channel and continuous contract of copper from that peak E top that was made, that doji top that was made in 2011. And look, you've gone all the way from the it's a continuous contract, so it keeps moving around. We're somewhere in the 4.78 area down to the low, most recent low of 2.440. I mean, that is a big move for copper to the downside, but it's taken time. When you take time, it means that you can draw a trend line like this, a trend line, which shows you a resistance. I take these, how can I put it? I don't want to diminish the effect of this trend line, other than to say it doesn't mean all that much, but when you break out above the resistance that's been set in place, what it does say is now that you have a change of trend and support coming in, but it doesn't say you've broken out, now you can go zipping all the way to the top. All it says is this trend line is now redundant. You can take it away because there are other patterns that you're going to look for. That's the way I read it. I know that many people look at the trend line and say, oh my God, you've broken out. This is a major thing. You go, there's no sign. You have to wait for other things to happen before that. If there's just one little tool in the toolbox that says, phew, finally you form some kind of a base. You should not break below that base for a little while as you try to go towards higher highs and higher lows, but it doesn't say you're going to break out and take out all the left side peaks. All it says is you finally found support. Now you can have a better idea of your new consolidation and breakout areas. That's really what it says. But this is good action so far in high-grade copper. And you can see that on the daily. I've got this as a new leg B. And we'll just treat it as that because the stochastics at 91% and the MACD is good. We had a very unfortunate thing the other day. We missed an entry on a copper position, a stock, and it was by 1 penny. And the darn thing went from 76. We wanted it at 75. It went from 76 to 92 in just days, just a day and a half, in fact. So that's the way it happens. Now let's go on. We got this high-grade copper. Now it's very important. We need to look at the TLT. Why? Because it broke under on Friday and closed under the 200-period exponential moving average. Remember, I like to look at these moving averages or doji candles or gaps. I look at them and I say, it's another piece of the puzzle. And we want to be able to assess that piece of the puzzle. And in our case, the 200-period moving average hadn't been touched. Yep, that's the music. Hadn't been touched, although we got very close to it over the last year. But until the breakout of that level back in April of 2014, that's over a year ago, it hasn't broken to the downside except for now. We'll talk about it.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. Berkshire Hathaway annual meeting this weekend. A lot of fuss going on. It's at 145.76, up 240, gapped up very nicely. But it's within a down channel from a peak F, a peak E in the weekly, and a G/C in the monthly. The monthly is suggesting to me, based on the technicals, that there's a chance that if the 9-period moving average in May is taken out, it's at 142.05. If there is a close on the last day of May below 141, there'd be a chance that you've got a deeper timeout, and it's telling us about the economy. I remember I spoke about this been speaking about it for a while, suggesting that a lot of the techniques that I use, a lot of the indicators that I use, and a lot of the anecdotal and peripheral stuff that I have at the back of my mind have been coming together for about the past 5-6 weeks to suggest that there's a chance we have been in, we'll only have it recognized later on, a weak economy. Now, whether it's a mini recession or what kind of pullback, it's very hard to say. But if you look at some of these key stocks, like a Berkshire Hathaway, BRK.B, these are the B shares, we've been going sideways to slightly down for a while. In the Berkshire Hathaway's case, I think it's from December. From December at 152.94. And it's been quite a while. It only went down to 141, or is it 140? Yeah, 140.33. So this is not bad. I mean, big deal, 10%, not even 10%. But it is the first pretty decent move in time and price since back in early 2014, where it hit 119.38. Berkshire Hathaway in August of 2013, and it was going sideways already for 3-4 months, and then it continued for almost a year. It went sideways before breaking out to the upside. So this is something to watch, and my guess is that well, we'll be going into much greater detail tomorrow night, but my guess right now is that the rotation that's been going on has been very selective, with fewer and fewer stocks propping the markets up, but a greater number are starting to show visceral signs of wear and tear that suggest any sudden pullback coming up over the next week or so would be an opportunity to push these things down further. Question of the day: would I buy or would I sell Berkshire Hathaway? Right now, I would not be buying Berkshire Hathaway now. That might mean that you're missing a great opportunity to retest 6 points higher, the previous high, and then it goes to leg D in the monthly. The way the chart is looking, it looks like it wants to get to leg D later in the year, something like later in the year, November maybe. Just taking a couple of months to really digest these big gains. Has had huge gains. Many stocks have had huge gains. So let me just say to you that if I had a core position, I would probably say stay with the core position, but I would be taking some profits on some part of the position by doing one of two things: a close on any daily basis below 142.50. It's just 2 points away, 3 points away. It's at 145.78. I would take some money off, and I'd be prepared to put that back in the 130s. We'll talk about exactly where in the 130s if it does come down, because then you get a better picture of where about. My guess right now is between 136 and 133.5, somewhere into that candle, but way above the low, which is 132.03, candle of October the 17th, 2014. And I would take some money off, and that's where I would want to put it back. Would I add to a position right now? No, I think it's just a little too risky. Yes, I say I might be wrong. You could go up another 5-6 points. You could make that leg D and then come down a little bit deeper. I don't think so at this particular point. Now, there's a bunch of things that I want to talk about. In the webinar that I'm doing tomorrow night, I'm going to talk about yields, talk about yields in the 1920s. And if we talk about yields right now, I should have taken that break to get out of this. Let's see, can I put that? Yeah, I don't really want to open that right now. Okay, so let's just do this. We've got the U.S. Treasury bonds, the 30-year T-bond itself, having made a peak E in the monthly chart within the rising channel. The 9-period exponential moving average at 158.5, let's call it, is above where it is right now because it's at 157, down 1930 seconds. So something else I want to talk about tomorrow night is what choices do the public and fund managers, or what do people around the world, what choices do they have if they are on either fixed income or if they are in a situation where, because of their age, the theory is to go more to bonds. That's just the way it is. What do? I mean, bonds are, record highs, all-time highs. Yields are almost at all-time lows. What are we talking about? Just safety? Well, people are saying safety schmafety. I've missed a double in the stock market at least. And here I am getting my 2% or 3%. Or if you've got, excuse me, if you've got munis, tax-free munis, maybe you can get 4, maybe 4.5 if you're lucky. Yeah. And I think those are the things we're going to talk about. Let me just mention once again, I'm doing a webinar coming up. It's coming up this Tuesday night, tomorrow night. And the most important thing I can say about it is that within the webinar, it's only 45 minutes. I'm going to touch on areas that are very important, areas that I will continue to talk about in my opening call. But most importantly, these are areas and charts that most of you don't get to see very often. if ever. In fact, some of them I picked them up because I did research to find out long-term charts, etc. Some are fabricated charts of the Dow and yields came back from 1870. I mean, that's amazing. Was it 1870 or was it 1700? Whatever it is, these are long-term charts. So I'm looking forward to that. Even more important about the webinar is I want to remember, for those of you who were in the first webinar of the Match with the 1920s, I spoke about learning how to enjoy the short side. You could be wrong, but you don't want to sit in fear saying, "Oh my goodness, I just, my gut, everything about it." Like in 2000 and in 2007 and 8. 2007, I know so many people that in their gut, they would have been selling, but everybody was saying, stay in the market, stay in the market. And as a result, their own intuition would have got them out, and their own intuition probably would have put them back in after the March low. But things were sounding so bad by everybody. I want you to learn how to enjoy it. So what I said is, let's have some of you who've never gone short before buy the 100% inverse of one of the indexes, and only a very small proportion. This is not even insurance or anything. It's really an experiment in learning that you can be short via without shorting. You can go long. In other words, you just buy it as if you're buying General Electric or something like that. But at the same time, what you would be doing is really the fund itself is made up of only short positions. And then you don't have to come up with money when you're really short something. You have to, if it goes against you, you have to be able to back up that money. If it's you're short at 100 and it goes to 120, you have to come up with those extra 20, whatever. So in this case, no, you know what your stop is, and that's it. And the irony is we got short by going long at 23.07, and it's over 2 months, and it's at 22.63 with all this time. Larry Pesaventa saying Basil is un-American. Yep, I'm sorry about that. Yeah, capital preservation. I'm trying to teach capital preservation. I'm trying to teach that you can, in fact, learn how to take a small position. If it's the first time you've ever done it, you better not take anything but a small position. And then we might add to that at some point. But first of all, you want to get used to not living in fear. This is just a little bit of protection of a little bit of your portfolio, and you'll learn that you can, in fact, start to develop the process that is the mechanism to be able to go short the market when you think it's appropriate in a very small position at first. And as you're doing that, you will also learn that there need not be a fear factor. You say, I'm prepared to lose 1%, 0.8%, 3%, whatever it is on that position, that small position. I don't care until I get hit for that loss. I don't care about it. It is just there. I've done the trade. I know exactly what I'm doing. There's no fear involved. That's really the issue. So please, consider at least coming to the webinar. There are a lot of things I'll be talking about in terms of how we can position ourselves for the next big move up. Now let me show you the bonds. If bonds close underneath 154.27, 30 seconds on the continuous contract, let me rather go to the TLT, because the TLT most of you can get. And it corresponds beautifully to the bonds. In this case, the low is 122.97. So far, the low today is 123.27. Oh, interesting. Yeah, a point away. We're going to be watching this closely because you've made your peak D, you've got your Chapman wave cup formation, cup and ladle breakout. Didn't hold it because D is where you expect, D or E is where you expect to come back and retest the lip, which is 132.21. You've gone under it. And that suggests that in this particular pattern, that if you take out 1/3 to half of the distance between the lip, the original lip that's at 132.21 back on this monthly chart back in July of 2012 to the low that was made at 101, I think, 101.17, December 13th. If this comes back and breaks, give you the exact number. Let's use the Fibonacci retracement. I'll use it if I can see it. Trend beginning 120. Nah, I'm not using it properly. It should be 108.60. No. What am I talking about? Let's just move up to that. There you go. 116. Let's call it 116. And right now we're at 123.36. If the TLT takes out 116, there's a real good chance it's going to go all the way to the bottom and retest that 101 area. But remember, my theme has been since, I don't even know when it was, because I know I was writing about it at the beginning of the 90s, mid-90s, that is, I'm sorry, in the mid-90s. So if the theme of the Japanization of our bond yields, in other words, if the Fed is still forced to keep rates low, and that's what I think is going to happen, then you'll find that there's going to be a handle that forms here, and the test will be if there's a close on a monthly basis above 132.48. That's last month's high. Not a big deal, but if there is a close above it, you should see a cup formation form and a retest of the high of 138.50. All right, those are the parameters. Make it as simple as possible. Now let's go to something else. The dollar is acting okay, considering that it pulled back quite sharply, but it's struggling. And my suspicion is that we are looking, you remember that pattern that I've talked about, that H pattern? So now I'm looking at this formation here that says if the dollar in May takes out 93.25, this is the dollar index, and it's at 95.38. Doesn't sound like much, 2 points, big deal, but this dollar has been very strong. So if it takes it out, you've got yourself a pattern that says, oh, whoa, be careful. But I'd say, whoa, be careful only if you get the counterpoint rally, and this is really important, the counterpoint rally that says gold is starting to take out the upper end of the range, this rectangle range, and is starting to pierce the 1227.50 in the continuous contract, which has been the repellent zone for so long. Since February the 6th, gold has not been able to even touch that level of the 200-period exponential moving average. So those are the things I'd be looking for. However, you can talk and talk and talk until the cows come home. How did that expression come about? The cows come home. Anyway, it's the VIX. Look, the VIX index went to a lower low today. It went to 1210. Wow, the 12s has been important for the volatility index. 1210, trading now 1291. Starting to show a little bit of signs of strength, but only strength on the day because it's lousy action. When you think about what happened from last week, Thursday, it was looking like there was a chance that Friday might close near that 1496 200-period moving average in the daily. Oh, no. The VIX index, I make it real easy for myself. The VIX index represents buying pressure and selling pressure. It's as simple as that. So we've got a question in the den. We still need to see a pop in G into form leg D in the weekly. Well, that's a good one. And I've got a question here from Keith in Orlando. Keith, I'll be with you straight after this break, and we'll talk about GE, and we'll go back to the VIX in a moment.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Do you know the 7 most critical factors that influence every decision you make, and how not knowing these will jeopardize the health, the wealth, and the relationships you deserve? I'm Steve Rhodes, morning host of TFNN.com, and for the last quarter of a century, I've studied and used the secrets of human growth, the same formulas used by leaders of nations, billionaires and millionaires, and the most successful athletes on the planet. Would you like to break through any obstacle that gets in between you and the success you deserve? Would you like to turn fear into strength? If you could find a way to achieve, be fulfilled, and live a life of meaning, wouldn't you want to know the answer? I'll teach you the factors that control your state of mind and the drivers that impact every thought, emotion, behavior, and action we take in my new webinar, The Psychology of Trading. Join me for this 2-part online event where I'll unveil the secrets to human pattern recognition, because they're not what you think. And soon, you'll have the health, the wealth, and the relationships you deserve. Just go to the homepage of TFNN.com and click on The Psychology of Trading to begin your journey now.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartley's, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Straight to Keith in Orlando. Keith, how are you?
Doing good.
Good. You'd like to look at GE. Do you have a position in GE?
Yeah, I'm actually in right now and just trying to see what's going on. I've been in it for a few months now and kind of tapered off a little bit here, so really wasn't moving much. But
so that you have, in fact, benefited from the big spike up to 28.68 and now it's at 27.45 because that's the highest point it's been for quite some time, right?
Correct.
Okay, so it's not that big a gain, but you are you're looking at a profit. That's really what we want to be looking at, and I'll take it from there. So we had a little discussion here in the Dan, Peak D and the Dan wanted to know about having made this recovery high at Peak C, 28.68 in, what was that? Was that in April? Yeah, April, the week of the 10th of April. There should be a leg D, and the answer is in this particular instance, there should be a leg D at some point. It's not giving you the time. It just says, having made this powerful leg C, and then holding nicely above the 9-period moving average of 26.63, it should go above 28.68. Now, this is what I'm looking at, and this is part of the studies that I've been doing over the last, I'd say, last week or so, and it's to see how stocks, the old school stocks, because we had the old school stocks like the Microsofts and the Intels suddenly have very good moves, and they go back, I mean, from the 2000 crash, they've had all this time to consolidate, and some of them now have had some very, very good moves, percentage moves, and I'm saying to myself, well, wait a minute. If this rotation is taking you into the old school of the high tech, will it? Microsoft, Intel, you've got Oracle, you've got a bunch of stocks that just suddenly came alive. Why would we not see something replicate that? Maybe in the heavy-duty stocks, and GE, for all its intents and purposes, is basically out of the financial part of it, having just, that's the reason why it popped up at 28.68 back in April after hovering around the 25s. And the reason is because they were selling off, a big chunk of the real estate portion. So now what I'm looking at is I'm saying, okay, if you can get a GE, maybe one of the big auto companies, maybe I got a little worried over the weekend because I was looking at a TWR, I think it was a TRW, which is in the automotive area. And I thought, all right, what's going on? Then I looked at it and I said, oh, this looks a little bit toppy. But then I looked at it a little closer and somehow it looks like it's had a takeover off it because it's gone sideways. But this is really one of the old school that used to be, a fantastic stock when the heavy duty stocks were rallying, the Dow type heavy duties. So I'm watching those and I'm saying, okay, if GE, which I call a pilot light indicator for my Dow Quartet, GE, IBM, Triple M, and UTX, if GE is in a way leading the pack, and we had that horrible down day last Thursday and then the big reversal on Friday, what is it saying? And I think what it's saying is that money seems to be flowing back into GE, that many people were caught by surprise. It was a bit of a short squeeze as well as new buying that went in on that very spiky day. That was the 9th of April. And that the way it's going to hold, I'd like to just do this one little thing. I'm going to draw another oh, that's the end of the show. You know what I'm going to suggest? You're in it. I would not do anything right now, but I would be watching 2650. It needs to hold that. If it pulls back under that, I'd be a little cautious. Call me again Wednesday and let's look at it together, okay?
Okay, thanks.
Thank you, Keith. Hold it for now, though. Folks, I'll be back tomorrow. Have a great day. Check out my webinar on Tuesday night.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.